Economics, money and banking. Money and banking. Money is anything that is generally acceptable as a medium of exchange or in the settlement of debts. Before the present form of money, goods used to be directly exchanged for goods, and this is called barter system of exchange. Barter system of exchange. This is where goods are directly exchanged for goods or services, for example chicken for salt, beans for sheep, etc. For a barter system of exchange to be successful, there should be a double coincidence of wants, i.e. for you to exchange with another person, he must have what you want and he must be willing to exchange it for what you have. Benefits of barter trade / advantages of barter trade. It saves the scarce foreign exchange / reduces the balance of payment problem. Countries that are not having foreign exchange can easily participate in international trade through the barter system. It facilitates trade among small countries, and this enables such countries to avoid trading with more developed countries, which sometimes exploits them, e.g. through the evil trade barriers. Barter trade allows some degree of specialization. A country specializes in production of those commodities which can be used in exchange of other goods that it does not produce, hence enjoying the advantages of specialization. It expands the range of markets. This is because trade does not involve use of money, therefore countries look for nations that want they have and have what they need. Barter trade does not experience the problem of inflation. This is because there is no money involved in the exchange of goods and service. Economics, money and banking. Lack of double coincidence of wants. It is difficult to find someone in need of what the buyer is selling and has what the buyer wants. For example, a man wanting to exchange goats for beans may spend several weeks before finding anyone who has beans for sale and happens to want goats. Indivisibility of some items / commodities. Some items can hardly be divided into small portions, hence limiting small transactions to take place, e.g. an individual with a goat finds it hard to exchange it with a hen. Difficulty in transportation of bulky items / commodities. Some items are heavy and difficult to move from one place to another in the process of looking for buyers. Some products are highly perishable and hence difficult to store. This limits future transactions. Difficulty in valuing commodities. It is hard to determine the value of one commodity in terms of the other without thinking about money, therefore some parties in the exchange cheat each other. E.g., when exchanging goats for a cow, it is not easy to determine the number of goats to give up for a cow. It is difficult to carry out transactions on credit. Many commodities lose or gain value over time. Therefore it is difficult to exchange them in a credit or lending arrangement. E.g., a transaction involving a promise to receive a goat is very hard to make because a goat can grow bigger or smaller. Question: outline 4 conditions necessary for the barter system of exchange to be successfully used in an economy. And B, owing to the above challenges, a generally acceptable medium of exchange was economics, money and banking were used to determine the value of other commodities and also serve many purposes, hence their ability to satisfy human wants / needs. However, these commodities could not measure well the value of all commodities because they were bulky and perishable. Later durable commodities were used, and these included gold, iron, silver, beads, cowrie shells. After some time, it was later discovered that some of these commodities were in plenty and they would not act as a good medium of exchange. It was therefore decided that gold and silver should be the only ones to act as a medium of exchange. However, as time went on, people were inconvenienced with carrying metals. This prompted the emergency of goldsmiths who would keep the gold and issue receipts to the owners. The receipts had the same value as the gold kept. This marked the beginning of paper money. Over time, more developments have taken place, and these include use checks, credit cards. Functions of money. It is a medium of exchange. Money makes it possible to determine the value and quantity of commodities to be exchanged. It facilitates the day-to-day transactions and enables people to easily get goods and services in exchange for money. It is a unit of account. Money permits pricing of goods and services, enables accounting and auditing of business transactions. It is a store of value / wealth. Money makes it easy for people to store their wealth in money terms. It is a measure of value. The relative value of goods and services or prices is determined through the intermediary of money. It reflects the quality and quantity of goods and services exchanged in the market. It is a standard of deferred payment. Money makes it easy for purchases to be made without immediate payment. This means that money facilitates and encourages international trade. Role of money / advantages of using money. Economics, money and banking. Encourages specialization / division of labor. Facilitates borrowing and lending. Makes deferred / future payments possible. Facilitates valuing goods and services. Promotes hard work in order to accumulate wealth. Increases the level of resource utilization due to demand for factors of production. Facilitates saving and investment. Makes it possible for government to influence the level of economic activities. Determines the distribution of income. Demerits of using money as a medium of exchange. Leads to inflation due to too much money in circulation. results into income inequality, results into corruption, leads to overexploitation of resources, creates social classes and lack of unity, leads to brain drain due to search for higher monetary payments, leads to rural-urban migration and the associated evils. Qualities of good money. 1. It should be generally acceptable/acceptability. This means that it should be approved by everyone in the country as the official legal tender. This is to ensure that it is accepted by everyone in the making of different transactions. 2. It should be portability. One should be able to carry money from one place to another easily. This is to ensure security for money and its holder. 3. It should be divisibility. Good money should be divisible into small denominations. Economics, money and banking. 6. Cognizability. Money should be easily seen and deduced with ease in relation to material, color and structure. It should not look like other forms of paper or coins. 7. Scarcity/good money should be relatively scarce. Money should be scarce as compared to its demand so as to enable people maintain it or even work harder to get it. 8. Malleability/it should be malleable. Money should be hard or difficult to imitate because if it is easy, it can easily be forged, hence an increase in supply and its related problems such as inflation. 9. It should be stable in value. It should maintain its value without over-appreciating or over-depreciating. This is to maintain people's confidence and trust in money. Concepts used in connection with money. 1. The gold standard. Gold standard is a system where the value of a country's currency is fixed in terms of gold. This implies that the currency is fully backed by gold. 2. The dollar standard. This is where the value of a country's currency is defined in terms of the dollar reserves held in the country. 3. Fiduciary issue representative money. Fiduciary issue is money issued by central bank at its discretion and it's not backed by gold or foreign reserves. It is money issued over and above that backed by foreign reserves or gold. The issue of such money is usually backed by government securities. 4. Fiat money. Fiat money refers to money printed and issued by the central bank on government orders irrespective of the level of economic activities. It is not backed by securities or gold, e.g., money printed to finance a war. 5. Common money. Common money refers to banknotes and coins in circulation hands of the public, and it's used to carry out day-to-day transactions. 6. Economics, money and banking. Near money refers to near liquid assets which can easily be turned into cash, for example treasury bills and government stocks, checks, foreign currency. 7. Intrinsic money. Intrinsic money refers to money coins whose metallic value is equal to the face value. 8. Token money. Token money refers to money whose face value is greater than the value of the metal used in making it. 9. Hot money. Hot money refers to short-term capital movements such as treasury bills, commercial bills, and speculative purchase of foreign currency that can be moved from one country to another. 10. Bank deposits. Bank deposits refer to money deposited with financial institutions and can be used to settle any financial obligations. Bank deposits are of two types. A. Sight demand deposits. Sight deposits are those which are withdrawn on demand by customers with current accounts. B. Time deposits. Time deposits are those which are withdrawn subject to some notice being given by customers of a bank. 11. Money market. A money market is one in which short-term financial asset securities are exchanged. Money markets have got the following features. They are mainly urban-based. They charge mainly high interest rates. They mainly operate on small-scale basis. There are few participants in the markets. They deal in a limited variety of financial assets. 12. Economics, money and banking. Institutions involved in the capital market include the central bank, commercial banks and saving investment institutions, e.g., insurance companies. The functions of a capital market: mobilization of savings, encourage investment, regulate the prices of financial assets, promote ease of convertibility of assets from near cash to cash form. 13. Stock exchange markets. These are financial institutions where already issued shares are sold and bought. 14. Treasury bill. Treasury bill is a financial security issued by a country's central bank as a means for government to borrow money for short periods of time, for example treasury bills of 90 days. 15. A bond. A bond is a financial security issued by businesses and government as a means of borrowing long-term funds, for example bonds for several years. 16. Loan. A loan is a specified sum of money advanced to an individual or a firm by a financial institution with a specified rate of interest over a given period of time. NB. Soft loan is a loan having either no interest rate or a very low interest rate, and it has a long-term repayment period. II hard loan is a loan with a very high interest rate and a very short repayment period. 17. Collateral security. This refers to an asset of value that is mortgaged/pledged against a loan given. 18. Overdraft. This is a short-term financial assistance by commercial bank to the current account holder where the customer is allowed to withdraw more money than he/she has on the account. 19. Bank draft. This is a check issued by the commercial bank on behalf of bank customer at a fee whereby the payee is not willing to accept a personal check. 20. Bill of exchange. Bill of exchange is an unconditional order issued by a person or business directing the recipient to pay a fixed sum of money to a third party at a future date. Economics, money and banking. 21. Paper note. This is money made out of paper materials by the central bank of a country, e.g., an oath of SHS. 1000. 22. Coins. This is money which is minted out of metallic materials, e.g., a coin of SHS 100. 23. Legal tender. This is money which according to the law must be accepted in making of transactions in a country at a given time. Money is legal tender in its country of issue. 24. Currency. This refers to the paper notes and coins that are being used as money in a country. Or, currency refers to the total stock of money in the country which includes foreign currencies that are not legal tender to the country. 25. Dear money. This is the money where the government deliberately keeps the rate of interest very high in order to reduce borrowing from the commercial bank. Demand for money/liquidity preference. Demand for money is the desire by the public/individuals to hold wealth in form of cash and near cash. Determinants of liquidity preference/demand for money. 1. Level of interest rate. High interest rate acts as an incentive for people to earn much from their money which encourages them invest it, hence a fall in liquidity preference. On the other hand, low interest rate increases the level of liquidity preference because people do not see much reward in investing their money to earn interest. 2. Economics, money and banking. Indifferent to economic activities due to low profit levels resulting from high cost of production. 4. Level of awareness about the services provided by commercial banks. Awareness about banking facilities encourages people to make use of them by keeping their money in banks, thus low liquidity preference. On the other hand, prevalence of ignorance about banking facilities makes people hold much cash, especially when they feel that they have to go through much hassle to bank or withdraw their money, thus high liquidity preference. 5. Level of transactions. Higher the level of transactions by customers leads to high liquidity preference because there is much need by people to hold money so as to have daily needs for survival. On the other hand, a fall in the level of transactions leads to low liquidity preference since there is less need to hold money for purpose of carrying out transactions. 6. Income levels. High level of income among people leads to low liquidity preference since they can easily invest their money elsewhere to earn them interest both in the short run and long run. On the other hand, people with low incomes tend to hold most of their wealth in cash since they are likely to need it any time. 7. Level of speculation. High level of speculation in securities with high interest leads to low liquidity preference as speculators invest their money in bonds and treasury bills to earn a profit. On the other hand, low level of speculation in securities with low interest leads to high liquidity preference as speculators prefer to have their money in cash form rather than investing it in securities. 8. Level of development of financial institutions/nature of distribution of commercial banks. High level of development of financial institutions leads to low liquidity. Economics, money and banking. Question. Explain the causes of high liquidity preference in Uganda. Motives of demand for money. According to John Maynard Keynes, people do not demand for money for its own sake but due to influence of some motives which include the following. 1. The transaction motive. This is the desire to hold money in cash balances for carrying out day-to-day transactions, for example buying food, fuel, clothes, paying for transport. The transaction motive is influenced by the following factors: the level of income, the general price levels, level of monetization of the economy, level of economic activities, the time it takes for one to receive money/income. 2. The precautionary motive. This is the desire to hold money so as to cater for unforeseen circumstances, for example, getting visitors, falling sick. The precautionary motive is influenced by the following factors: the level of income of people, the cost of insurance and health facilities, business opportunities for unexpected profitable deals, the level of inflation in an economy, the time it takes for one to receive money. 3. The speculative motive. This is the desire to hold money in cash balances by people so as to earn more incomes and profits in near future through speculation. The amount demanded for this purpose depends on interest payable to treasury bills and bonds, i.e., at a high rate of interest speculators prefer to hold securities instead of money, whereas economics, money and banking, or liquidity trap is a situation where the interest rate is too low to break the liquidity preference. The speculative motive is influenced by the following factors: the interest rate in financial institutions in relation to returns, the level of people's income to buy securities, the business trends in the country, whether favorable or unfavorable, the willingness of the public to buy securities. 4. Finance investment motive. Finance motive is the desire to hold money in cash balances in order to finance ongoing investments. The finance motive is influenced by the following factors: marginal efficiency of capital, availability of investment incentives/government policies towards investment, the political climate, money supply. Money supply refers to the total amount of money in circulation in an economy at a given period of time, in form of bank notes and coins, or the currency in the hands of the people, plus that on demand deposits/current accounts within the commercial banks in an economy at a given period of time. There are two types of money supply: exogenous money supply, economics money and banking. Economics money and banking. 13. Level of inflow and outflow of funds. High level of inflow of funds by foreign investors, remittances by nationals living abroad, by tourists from abroad, leads to high the level of money supply. On the other hand, high level of outflow funds in form of profit and income repatriation, expenditure on imports, investing in the outside economy, leads to low level of money supply. Government monetary policy through the central bank. An expansionary monetary policy leads to high level of money supply because the intention is to increase the amount of money in circulation. On the other hand, restrictive monetary policy leads to low level of money supply because the intention is to reduce the amount of money in circulation. Level of liquidity preference. High level of liquidity preference leads to high money supply because people prefer holding money rather than assets. On the other hand, low level of liquidity preference leads to low money supply because people prefer holding assets other than money itself. The interest rate. High interest rate means low rates of borrowing, which eventually leads to lower level of money supply. On the other hand, low interest rate means high rate borrowing, which eventually leads to a high level of money supply. Level of monetization in the economy / size of the subsistence sector. The economy that is highly monetized, the level of money supply is high since production is for commercial purpose and more money is required for exchange. On the other hand, the economy with a big subsistence sector, the level of money supply is low because production is for own consumption and not for sale, therefore less money is required. Economics money and banking. 14 levels of credit creation, limits the amount of money / credit created, leading to low money supply. Level of government borrowing. This is mainly done through the buying of securities, i.e. when the public buys securities, money is borrowed by the government, which lowers the level of money supply in the economy. On the other hand, with the government / the central bank buys back securities from the public, it leads to high money supply in the economy. Balance of payment position of a country. The balance of payment surplus in an economy leads to increase in money in circulation, leading to high levels of money supply, this due to the increased foreign exchange inflow. While a balance of payment deficit leads to low amount of money in circulation, leading to low levels of money supply in the economy, this is due to low foreign exchange inflow in the country. The level of printing and issuance of currency. Excessive printing and issuance of currency by the central bank increases the amount of money in circulation, hence increasing money supply. On the other hand, limited printing and issuance of currency by the central bank reduces the amount of money in circulation, hence low levels of money supply. Question: account for the high money supply in developing countries. The quantity theory of money, Irving Fisher, 1911. The quantity theory of money states that the general price level is determined by the quantity of money in circulation, assuming that the velocity of circulation of money V and the level of transactions T are constant. The quantity theory of money is represented by the Fisher equation. Economics money and banking. 15. Where M equals quantity of money in circulation, V equals velocity of circulation of money, average number of times each unit of a currency changes hands in financing a transaction. P equals general price level, T equals level of transactions, total amount of goods and services supplied. Examples. 1. Given that the volume of money in an economy is £20 billion, total level of transaction is £250 million and the velocity of circulation is 20. Calculate the general price level in the economy. 2. Given that the quantity of money is SHS, 1 million, velocity of circulation is 20 and the price level is SHS 80,000, calculate the volume of transaction. 3. Assuming velocity of circulation and transactions made are held constant, i.e. 10 and 50 respectively, but money supply is doubled from SHS 100 to SHS 200, calculate the new price level. Assumptions of the quantity theory of money. The theory assumes that the velocity of circulation of money and the level of transactions are held constant. This is to allow the money in circulation and the general price level to change in the same proportions. The theory assumes that all the money received by the people is spent on goods and services, or it is for transitory motive. Prices are assumed to be determined by the amount of money supplied only. The theory assumes that there is no hoarding or saving of money because if money supply is increased and volume of savings is also increased at the same rate, the general price level would remain constant. The theory assumes that all transactions use money as a medium of exchange for goods. Economics, money and banking. 16. The theory is applicable in the sense that when money supply increases, in most cases prices of goods increase. Limitations of the quantity theory of money. The theory only attempts to explain changes in the value of money but does not show how the value of money is determined. The theory assumes that the demand for money is only for transaction motive, ignoring other motives like precautionary and speculative motives. The theory does not take into account other factors that bring about a change in the general price level other than the money supply, e.g., cost of production, cost push inflation, forces of demand and supply and pull inflation, changes in foreign exchange rates. The theory assumes the velocity of circulation v and the level of transactions t are constant, and this is not the case in real life as the two variables can change according to changes in economic conditions. There is no general price level but rather a series of price levels given the fact that price is responsive to forces of demand and supply. The theory ignores the influence of interest rate on the general price level and money supply. This is because high interest rate discourages borrowing, hence low money supply. An increase in money supply may result into high level of savings if the marginal propensity to save is high. This reduces the velocity of circulation, the rate at which money changes hands, and then the prices may fall instead of increasing. Economics, money and banking. 17. Bargaining/haggling between buyers and sellers to reach agreeable price is not taken into account by the theory, i.e. the buyer may be in a strong bargaining position, the price will not increase. Government price legislation/control in form of maximum price is not catered for by the theory, and yet the government may come into low prices. The quantity theory of money is just an expression truism which merely shows the relationship between four variables m, v, p, t, but not a true theory. The four variables m, v, p and t are not independent of one another because a change in one induces change in others. It ignores barter trade because it assumes that all transactions are affected by use of money. It ignores the demand for money and only looks at money supply in an economy, and yet there could be genuine demand for money. Circumstances under which an increase in money supply may not necessarily lead to an increase in the general price level. When there is a corresponding increase in the level of output of goods and services in a country. If the increased money supply is used to purchase capital goods for investment, prices will remain constant. When there is a high marginal propensity to save, the increased money supply will not lead to inflation/increase in price, the money will be saved. Where there is government control over prices, i.e. if the government fixes the maximum prices. Economics, money and banking. 18. When the country imports large amounts of commodities from cheap sources. The value of money. Value of money refers to the amount of goods and services a unit of money can buy. Or value of money refers to the purchasing power of a unit of money. If the volume of goods and services is big from a fixed quantity of money, then the value of money is said to be high and vice versa. Value of money can be categorized as nominal value. This refers to the face value of notes and coins irrespective of what value it can command in terms of goods and services. Real value. This refers to the amount of goods and services that can be bought using a given amount of money. Intrinsic value. This refers to value of paper or metal from which money is obtained. Factors influencing the value of money. The price level/rate of inflation. High rate of inflation leads to a reduction in purchasing power of money and a fall in value of money. On the other hand, low rate of inflation leads to a rise in purchasing and value of money. The quantity of money in circulation. High level of supply of money leads to excessive demand for goods and services, which leads to an increase in prices, hence a fall in value of money. On the other hand, low level of supply of money leads to a fall in aggregate, which leads to a decrease in the general price levels, hence a rise in value of money. Economics, money and banking. 19. The velocity of circulation of money. High velocity of circulation of money leads to a fall in value of money because it leads to high price level. On the other hand, low velocity of circulation of money leads to a fall in price level and high value of money. Government policy of devaluation and revaluation. Under the devaluation policy, the government deliberately reduces the value of money, while with the revaluation policy, the government deliberately increases the value of money. Question: outline 4 causes of the low value of money in developing countries. Banking. Banking is a business activity of accepting and safeguarding money owned by individuals and business entities, and then lending it out in order to earn a profit. Banking is done by financial institutions which direct the flow of money to productive use and investments. Financial institutions, intermediaries. Financial institutions are institutions that accept deposits from the public and extend. Economics, money and banking. 20. These institutions deal in money as their commodity, and they usually serve as channels through which savings flow into productive investments, and they charge a price known as interest. Financial institutions are broadly categorized as 1. Banking financial intermediary/institution. These are financial institutions that receive/accept deposits from the public, give out loans, and create credit/create new bank deposits. They include the commercial banks. 2. Non-banking financial intermediaries/institutions. These are financial institutions that receive/accept deposits, give out loans, but do not create credit. Examples are development banks, cooperative societies, insurance, corporations, housing finance companies, saving and credit institution, for example, NSSF. Differences between banking and non-banking financial intermediaries. Banking financial institutions require high-value assets as collateral security to access to loans, while non-banking financial institutions do not require a lot of high-value assets as collateral security for loans. Non-banking financial intermediaries are development-oriented, for instance, development banks, unlike the banking financial institutions such as commercial banks. Banking financial institutions only invest in less risky ventures or projects such as certificate of deposits, savings accounts, while non-banking financial institutions undertake investments in risky projects such as mining, agriculture, etc. Economics, money and banking. 21. Banking financial intermediaries create credit through use of checks, which is not the case with non-banking financial intermediaries, which obtain funds from development-oriented institutions such as IMF and World Bank. Banking financial institutions charge a high interest rate as they are profit-motivated, while the non-banking financial institutions charge a low interest rate as they are development-oriented. Banking financial intermediaries carry out investments in financial assets like treasury bills, bonds, stocks, foreign exchange, while non-banking financial intermediaries carry out investments in real assets like roads, houses, factories, and railways. Banking financial institutions normally offer short-term loans to customers, while non-banking financial institutions offer long-term loans for capital development expenditure. Functions of non-banking financial intermediaries: accepting deposits, advancing loans to borrowers, promoting social security, for example, NSSF, indemnifying/compensating for losses as the case is with insurance companies, providing advice to investors. The role of non-bank financial intermediaries in development: they mobilize savings in the country because they allow the public to deposit their money with them. They facilitate investment in the economy by extending loans to the people, especially those dealing in long-term projects. They lead to development of infrastructures in the economy because they provide loans for putting up of good infrastructure in the country. Economics, money and banking. 22. They provide revenue to the government through taxes that are imposed on these institutions. They promote the development of entrepreneurial skills through providing investment resources that people use to start businesses. They provide for the social welfare of the people through pension schemes by the social security institutions and the insurance companies. They promote trade and commercial activities by lending people for various purposes. They act as capital markets where capital resources are obtained for long-term investments. They promote development of labor skills. They promote economic growth. Banks. A bank is a business institution which accepts and safekeeps money deposits from savers and extends loans to borrowers with the aim of making profits. Types of banks. Development banks. This is a bank mainly created by a state or governments of neighboring countries to promote economics, money and banking. 23. They give out loans for investment purposes, especially where commercial banks cannot manage. They encourage growth of risky but developmental ventures like mining, agriculture. They attract foreign technical assistance required in the development of vital areas. They initiate long-term lending to individuals, institutions whose projects are deemed necessary for development of the country. The central bank. A central bank refers to a central monetary institution which is responsible for financial management and controlling other financial institutions in a country to ensure macroeconomic stability. Examples include Bank of Uganda, Central Bank of Kenya, Bank of England, etc. Specialized banks. These are commercial banks which are set up to serve a special type of customers with specific services, e.g. housing finance banks, cooperative banks, development finance banks, etc. Savings banks. These are banks which are set up to promote the culture of savings among people in the country. They attract deposits of any size but limit the withdrawal facilities. Commercial banks. Commercial banks are financial institutions which carry out financial businesses by accepting deposits from the public and lending out money on profit motive. Examples in Uganda include Standard Chartered Bank, Stanbic Bank, Centenary Bank, Diamond Trust Bank, etc. Economics, money and banking. 24. Advancing loans to trustworthy customers. This is done through offering different loan products on short-term and long-term basis. Such loans help the customers with financial difficulties, e.g., a bank overdraft is an example of a short-term loan. Act as custodians of their customers' valuables/clients. Commercial banks provide strong rooms to keep customers' valuable items like academic documents, land titles. Economics, money and banking. 25. Issuing of various forms of instruments of credit/provide easy means of payment such as checks, drafts, credit and debit cards. They provide excellent means of enabling payments. These facilitate the transfer of money from debtors to creditors. Issuing letters of credit to and act as referees to their clients. Commercial banks act as referees or guarantors on behalf of their clients who are buying goods on credit, providing advice to the investors on possible investment choices. This advice is mainly financial or business related. E.g., they assist customers to make realistic business proposal and business plans. Underwrite shares and debentures of companies as well as discount bills of exchange/financial securities. Commercial banks trade in issued securities as primary dealers who sell them to other interested clients. They act as trustees and executors of property and will of their deceased clients/customers. Here they accept to manage the property or estates of their deceased clients to benefit the deceased family. They carry out exchange of currencies of different countries. They buy and sell local and foreign currencies. Here they act as foreign exchange bureaus. The role of commercial banks in development. They facilitate mobilization of savings from the public by enabling them to open up different types of accounts to save their money. Economics, money and banking. 26. They encourage monetization of the economy by promoting exchange using money. They also lend money to people to carry out production for the market. Commercial banks promote skills development by providing on-job training to their employees. They facilitate and stimulate the development of infrastructures in the economy, i.e., government participate in the construction of buildings, roads, communication networks in order to improve their services. They increase government revenue. This is because they pay taxes imposed on their profits to the government. They facilitate and promote trade both internal and external by enabling traders to transfer their money safely. They encourage capital accumulation through encouraging savings and investment. They contribute investment capital in the country through buying shares from various public limited companies. They promote economic growth, increasing investment and output. They promote exploitation of idle resources in the country through encouraging investment. Economics, money and banking. 27. They provide employment opportunities because commercial banks employ people to perform different tasks in their different branches and departments, e.g., accounts, managers, cleaners, security guards, etc. They promote good international relationships among countries, i.e., between them, while the country and the host country, and this promotes international peace. They facilitate investment in the private sector through the provision of loans to the potential investors. They promote efficiency in the banking sector through creating stiff competition with the local banks. They facilitate the process of international trade by exchanging the foreign currencies for importers and exporters. They offer international banking services because government collects taxes from the banks. They promote development of local managerial skills through demonstration effectiveness. The people employed learn a lot from expatriates, and in addition the banks provide training banking skills. They increase the rate of monetization of the economy because the loans they give out help people to produce for commercial purposes. They contribute to the development of infrastructure in an attempt to improve on their services. Government participates in construction of roads, buildings, extension of power supply in areas where they operate, etc. They facilitate technological transfer in the economy because they transfer modern methods of banking into the country, e.g., computerized banking services including the use of automated teller machines (ATM). They increase the rate of capital inflow into the country by facilitating the transfer of money by citizens of the host countries. Economics, money and banking. 28. They promote economic growth. Negative role of foreign-owned commercial banks. They worsen the balance of payment deficit because of the increased profit repatriation. There is limited creation of employment opportunities in the country because the banks mainly use capital-intensive technology which is labor-saving, and also they have discriminating employment policies in that they prefer employing foreign manpower, especially at ranks jobs. They outcompete local banks because they have more finances and better technology than the local banks. They encourage rural-urban migration and its related evils since the banks are concentrated in urban areas which attract people from rural areas to urban areas. Economics, money and banking. 29. They make the implementation of the monetary policy difficult because they do not cooperate with the central bank since they have a lot of cash to inject in the economy from their mother banks abroad, i.e. they rarely borrow from the central bank. They discourage mobilization of savings because they require high initial deposit which many people cannot afford. They worsen income inequalities. They lead to imbalances in regional development. Question: what are foreign-owned commercial banks? We examine the role of foreign-owned commercial banks in Uganda. Problems facing commercial banks in developing countries. The limited/small size of bank deposits because of the high level of poverty among the people, which limits the number of clients to the bank. The limited number of credit-worthy customers / there are a few credit-worthy borrowers who can pay back the loans advanced to them, hence limiting expansion of the banking sector. Political interference in the management of commercial banks, and this makes it difficult for banks to make decisions on their own, i.e. they are forced to function according to the desires of the government. Political instability / high levels of insecurity where people fear to borrow for investment, therefore funds remain underutilized in commercial banks. Banks can't easily extend to rural areas for fear of losing property and depositors' money. Limited skills among banking officials, which makes them incompetent to run the commercial banks. The inadequate supply of skilled manpower to manage the bank forces the banks to hire foreign managers who are highly paid, leading to a high cost of production. Low levels of accountability or high level of corruption among banking officials, which makes commercial banks to incur huge losses, leading to closure of many of them. E.g. Economics, money and banking. 30. Stiff competition with other financial institutions such as microfinance institutions, post office savings banks, savings, mobile money services and credit cooperatives, all of which make commercial banks earn little profit. High liquidity preference by the people, which reduces savings with commercial banks. Poor infrastructure, especially the unstable networks. Corruption, which leads to loss their customers' money. Ignorance of the public / people about banking facilities. This limits the use of commercial banks by the population, resulting into low deposits. Measures that may be taken to improve the performance of the banking industry in developing countries. And encourage extension of banking services to rural areas. Close the banks that do not meet the minimum requirements. The central bank should undertake close supervision of the commercial banks. Sensitize the public on the importance of banking. Encourage training of more bankers. Increase people's income so as to increase their deposit with banks. Government should reduce her interference in the activities of commercial banks. Ensure political stability so as to promote economic activities which will motivate people to borrow for investment purposes. Develop infrastructure. Fight corruption. Features of commercial banks in Uganda. They are mainly urban-based. They are generally weak and underdeveloped. Most of them are foreign-owned. Many have a weak capital base. They mainly charge high interest and service fees. Economics, money and banking. 31. Re-examine the factors that influence performance of the banking sector in Uganda. 2. Explain the functions of banking financial intermediaries in Uganda. B. Assess the contribution of banking financial intermediaries to economic development in Uganda. 3. Distinguish between banking financial institutions and non-banking financial institutions. B. Examine the challenges faced by banking financial institutions in Uganda. 4. Outline the functions of non-banking financial intermediaries in Uganda. B. Describe the role of non-banking financial intermediaries in Uganda's economic development. Assets and liabilities of commercial banks. Assets of commercial banks. Assets or possessions of a bank plus its claims on other financial institutions and customers. Assets include the following: cash at hand in local and hard currencies, reserves with central bank, investment in securities including treasury bills, bonds, fixed assets in form of land, buildings, etc., loan advances and overdrafts to customers, long-term investments, deposits with other banks and non-bank financial intermediaries, interest on loans advanced to customers, liabilities of commercial banks. Liabilities are claims against the assets of the bank by its creditors, depositors, or what the bank owes. Liabilities include the following: economics, money and banking. 32. Share capital, customer deposits, deposits by other banks, government funds deposited in the bank, dividends payable to shareholders, reserve funds payable to the central bank, bills discounted with the central bank. Conflicting objectives of commercial banks. Commercial banks are always faced with the dilemma of achieving various objectives of liquidity, profitability and security. G. If the banks increases lending so as to earn more profits, it won't meet the customer's money demand, which will make them lose confidence in the bank and thereby depositing less of their money in the bank. In the same way, when they maintain liquidity to attract confidence in the customer, the banks will not get profits and therefore there will be no funds for lending. Commercial banks therefore have to find a way of reconciling the conflicting objectives. How commercial banks ensure liquidity. Commercial banks undertake the following to ensure that they always have cash to give their clients. By purchasing of short-term securities that can be turned into cash easily, e.g. buying treasury bills. They lend out money in phases such that at all times there is some money to meet the daily cash requirements. By maintaining the cash ratio. This is intended to have sufficient cash to meet the daily demands of the customers. Maintaining a minimum balance on the different accounts of their customers. Economics, money and banking. 33. How commercial banks ensure profitability/maintain profitability. The commercial banks undertake the following to ensure that they make profits. Advancing loans and overdrafts at a given interest. Here, commercial banks charge interest depending on the amount of money borrowed and the time taken. The interest earned improves profitability. Undertaking investments in profitable projects. The commercial banks invest their money in businesses/projects that are highly profitable, e.g., investing in real estates and securities. They charge fees for their different services, e.g., they have bank charges, ledger management fees, charges on money withdrawals, etc. Such money is accumulated to create profits for the banks. Charging a commission for services rendered to customers, e.g., where they act as custodians of estates of the deceased. The commission they earn improves their revenue and profitability by discounting bills of exchange and promissory notes at a fee. They buy shares in other companies like other members of the public. Commercial banks buy shares floated by companies. From these, they earn dividends annually to improve their revenue and profits. How commercial banks ensure security. Commercial banks ensure security in the following ways. They demand for marketable collateral security to extend loan to their customers. They spread their assets in different categories of liquid assets, e.g., cash deposits with other banks, fixed assets, etc. They extend short-term loans and avoid long-term loans. They put up strong buildings where they carry out their activities. Economics, money and banking. 34. Credit creation is the process by which commercial banks create excess deposits/new deposits out of the initial deposits made by customers. This is through lending out excess funds to credit-worthy borrowers who deposit the borrowed funds at different branches of the same bank. Assumptions of credit creation. It assumes that there is a fixed cash ratio, e.g., 10%. It assumes a fixed initial deposit, e.g., SHS 100,000. It assumes that there are several banks in the system multi-bank credit creation process, or there is only one bank with very many branches unibank credit creation process. It assumes that when people get loans in form of checks, such checks are deposited in other banks or in other branches of the same bank. It assumes that the public are willing to borrow money from commercial banks. It assumes that the public should be creditworthy. It assumes the use of checks, i.e., there must be a large number of current account holders so that commercial banks use the deposits to create credit. It assumes that there are many people willing to deposit money in a bank, therefore have confidence in the bank. It assumes that commercial banks are willing to give/lend money to the public. The basic terms used in credit creation: bank deposit/credit multiplier. Credit multiplier is the number of times by which an initial bank deposit multiplies itself to generate a final change in total credit created/total bank deposits. Credit multiplier equals letter 1D47B, letter 1D490, letter 1D495, letter 1D48, letter 1D4AD. Letter 1D48 for letter 1D493, letter 1D486, letter 1D485, letter 1D48, letter 1D495, letter 1D48 for letter 1D493, letter 1D486, letter 1D48, letter 1D495, letter 1D486. Letter 1D470, letter 1D48, letter 1D48, letter 1D495, letter 1D48, letter 1D482, letter 1D485, letter 1D486, letter 1D491, letter 1D490, letter 1D494, letter 1D48, or equals. Economics, money and banking. 35. Cash ratio. This is the proportion/fraction/percentage of commercial banks' deposits that must be kept/remain in the bank in cash form to meet the cash demands of depositors. This is not lent out to borrowers. Reserve ratio. This refers to percentage/fraction of the commercial bank's total deposits which is either kept with the commercial bank as cash ratio or with the central bank as legal reserve requirement. Question. Outline 2 reasons for maintaining a fixed I. Cash ratio. Roman 2. Legal reserve ratio in economy. Liquidity ratio. This is the proportion of total deposits of a commercial bank that is kept in cash and/or near cash form. The process of credit creation. 1. Receiving an initial deposit of the first banker from customers/depositors, e.g. SHS 100,000. 2. Keeping a certain percentage of the initial deposit as cash ratio, e.g. 30% or SHS 30 as cash reserves. 3. Lending out the remaining percentage of the initial deposit as a loan to a trusted borrower, i.e. SHS 70 4. Receiving the money lent out as new deposit by another /the second bank pre-i.e. 70,000 equals. 5. Keeping a percentage of the new deposit by the second bank as cash ratio, letter 1D453, letter 1D455, letter 1D45 example. 30% of SHS 70 0 equals or SHS 21 0 equals. 6. Lending out the remaining part of the new deposit to a trusted borrower by the second bank for i.e. SHS 49 0 equals. 7. Economics, money and banking. 36. 1. Letter 1 D450, letter 1 D44, letter 1 D460, letter 1 0B, letter 1 D45F, letter 1 D44, letter 1 D461, letter 1 D456, letter 1 D45C equals 100, 0 times 3.33 equals SHS 333,000. Illustration of credit creation. Given that banker has initial deposit of SHS 100, 0, and the required cash ratio is 30%, credit is created as shown in the table below. Bank/branches initial deposits / new deposits. Cash ratio 30%. Loanable funds. 100,000 equals 30's 100,000 equals 30,000. 100,000 minus 30,000 equals 70,000. B. 70,000 equals 70,000 equals 21,000. 70,000 minus 21,000 equals 49,000. C. 49,000 equals 49,000 equals 14,700. 49,000 minus 14,700 equals 34,300. T. 34,300 equals 34,300 equals 10,290. 34,300 minus 10,290 equals 24,010. A. Up to N. And B. Total credit created for 4 banks equals 100,000 plus 70,000 plus 49,000 plus 34,300 equals 253,300 / equals. Questions. 1. Given that the initial bank deposit in a bank is shillings 10 million and the cash ratio is 20%, determine I. The credit multiplier. Roman 2. The total credit that will be created in a multi-bank system. 2. Given the cash ratio of 0.2 and the total deposit created equal to shillings 200 million, calculate the initial deposit that was available in the bank. 3. The initial deposit in the banking system is $50,000. The cash ratio is 10%. Determine the total credit that will be created if there are 3 banks in the system, and B. If the number of banks is given, use a table to calculate the total credit / deposits created. Otherwise, use the formula. Economics, money and banking. 37. Factors influencing the process of credit creation. Level of liquidity preference by individuals. High demand for cash implies that people deposit less in commercial banks, and this reduces the ability of commercial banks to lend, hence low credit creation. On the other hand, low liquidity preference implies that individuals make large deposits into commercial banks. This increases the funds available for lending, thus promoting the process of credit creation. Size of the cash ratio. The higher the cash ratio, the lower the level of credit creation, since banks retains much of the deposits which limit lending. However, the lower the cash ratio, the higher the level of credit creation, since banks are able to retain less of the customer's deposits, which limits the amount of money for lending. Interest rates on loans. High interest rate on loans lead to low demand for loans as borrowing becomes expensive, hence limiting credit creation. On the other hand, low interest rate on loans lead to high demand for loans as borrowing becomes cheap, thus promoting the process of credit creation. Availability of collateral security. Presence of collateral security encourages commercial banks to lend out money to the public, hence high level of credit creation. On the other hand, absence of collateral security discourages commercial banks from lending out money to the public, thus low level of credit creation. Economics, money and banking. 38. Economic activities require use of money, hence increased borrowing from commercial banks. On the other hand, a large subsistence sector reduces the amount of credit created, as most of activities done do not require a lot of funds, hence reduced borrowing from commercial banks. Nature of distribution of commercial banks / level of development of the banking sector. Even distribution of commercial banks in a country promotes credit creation, as lending services are within the reach of the customers. Alternatively, even distribution of commercial banks encourages saving, thus increasing the size of bank deposits. On the other hand, poor distribution of commercial banks limits the credit creation, as lending services are not wholly accessed by the public, and at the same time it limits the size of bank deposits. Level of awareness of people about the banking services. High level awareness about banking services promotes the process of credit creation. This is so because many people are knowledgeable about the existence of bank loans and therefore go for loans. On the other hand, limited knowledge about bank loans limit the process of credit creation because few people go for bank loans. Availability of funds for lending / size of bank deposit. A large amount of bank deposits increases the loanable funds and that promotes the process of credit creation. On the other hand, a small amount of bank deposits reduces the loanable funds, which limits the process of credit creation. Degree of accountability in the commercial banks. Transparency in commercial banks promote the process of credit creation because bank officials do not ask for bribes before advancing loans, thus encouraging the public to borrow. On the other hand, low level of economics, money and banking. 39 opportunities in the country results into low demand for loans, hence limiting the process of credit creation. Availability of credit-worthy borrowers/customers. The existence of many credit-worthy customers promotes the process of credit creation because there are many people qualify for bank loans. On the other hand, a small number of credit-worthy customers limits the process of credit creation because few people qualify for bank loans. Political climate/atmosphere. Political instability discourages borrowing and lending, and this limits the process of credit creation because people fear to lose their lives and property. On the other hand, political stability encourages borrowing and lending, which encourages investment because people are not scared of losing their lives and property. Limitations of credit creation. High liquidity preference. High cash ratio. Lack of collateral security, houses, gold, machinery, land titles, vehicles. Limited number of commercial banks. Limited number of commercial/poor distribution of commercial banks. Limited investment opportunities. Ignorance of the public about banking service. High interest rates on loans. Restrictive monetary policy. Large subsistence sector/low levels of commercialization. Political instability/political turmoil. Low levels of accountability. Limited number of credit-worthy borrowers. Low level of bank deposits/low level of savings. Factors that promote credit creation. Low level of liquidity preference. Low cash ratio. Economics, money and banking. 4G. High number of commercial banks/even distribution of commercial banks. Large number of investment opportunities. High level awareness of the public about banking services. Low interest rates on loans. Expansionary monetary policy. Low level of subsistence sector/high levels of commercialization. Presence of political stability. High levels of accountability. Large number of credit-worthy borrowers. High level of bank deposits/high level of saving. Question 1. Explain the factors that limit credit creation in an economy. B. Suggest measures that can be adopted by the government to increase the rate of credit creation in an economy. 2. How do commercial banks create credit in an economy? B. Examine the determinants of the size of the bank deposit multiplier in an economy. Interest rate determination. Interest is generally the monetary reward for capital. As used in money and banking, interest is the cost of borrowing money, or the monetary payment made for use of borrowed money. Interest rate is the rate at which borrowers are charged for using borrowed money over a given period of time. Types of interest rates. 1. Nominal interest rate is the rate of interest before making adjustments to cater for inflation. 2. Real interest rate is the rate of interest where adjustments have been made to cater for inflation. Real interest rate equals nominal interest rate of inflation. Economics, money and banking. 41. 1 simple interest equals letter 1 D443, letter 1 D445, letter 1 D447. 100. Where P equals principal amount of money borrowed. R equals rate of interest. T equals time E, G1. Calculating the simple interest on a loan of SHS 100,000 lent out at a simple interest rate of 10% per annum for a period of 5 years. Solution. Simple interest equals letter 1 D443, letter 1 D445, letter 1 D447. 100. Equals shillings 50,000 to compound interest. C equals a P. Letter 1 D45F. Letter 1 D461. Equals pound plus P100. Where P equals principal sum borrowed. A equals total amount of money to be paid back, which include letter 1 D45F. Letter 1 D461 the principal and the interest which is got by equals pound plus 100 G. Calculate the compound interest on a principal sum of SHS 100,000 borrowed for a period of 5 years, a compound interest rate of 10% per annum. C equals a P. Letter 1 D45F, letter 1 D461. Equals pound plus P 100 equals 100,000 1 plus 10 5 100,000 100 equals 161,051 100,000. Economics, money and banking. 42. Reasons why interest is paid by borrowers to lenders. To reward individuals for saving the money that is lent out / for growing consumption. To compensate the lender for some / part of the risks of lending. To cater for some of the expenses incurred during the process of lending, for example the legal fees, ledger fees, etc. To reward the lender for the inconveniences he goes through in order to lend. To compensate the lender for loss in the value of the money lent out in times of inflation. Determinants of the rate of interest in an economy. Supply of loanable funds. High supply of loanable funds leads to low interest rate. This is because lenders do not make borrowing cheap so as to attract borrowers. On the other hand, low supply of loanable funds leads to high interest rate. This is so because there are many borrowers competing for the few funds, and therefore the lenders take advantage and hike the interest rate. Period of loan repayment. Long repayment period attracts high interest rate because of the high risks involved. On the other hand, short repayment period attracts low interest rate because of the low risks involved. Level of demand for loanable funds. Investment capital. High level of demand for loanable funds attracts high interest rates since customers show a lot of interest in using loanable funds. On the other hand, low level of demand for loanable funds reduces interest rates so as to attract customers to borrow money. Level of money supply in an economy. High level of money supply leads to a high interest rate because of loss in value of money, but low money supply leads to low interest rates due to the high value of money. The price level / rate of inflation. Inflation leads to high interest rates so as to discourage. Economics, money and banking. Economics, money and banking. 44. Number of banking institutions / level of development of banking sector. High level of development of banking institutions leads to low interest rates because there are many banking institutions which compete for borrowers. On the other hand, low level development banking institutions leads to high interest rates because there are few banks and less competitions for borrowers. Government monetary policies. Restrictive monetary policy attracts high interest rate because the central bank wants to reduce amount of money in circulation. On the other hand, expansionary monetary policy attracts low interest rate because the central bank wants to increase amount of money in circulation. More concepts used in banking. 1. Credit. This is a financial facility which enables an individual or firm to borrow money to purchase products or materials over an extended period of time. 2. Instruments of credit. Instruments of credit are written documents which guarantee payment in the near future, and they give the holder a right to receive money. Examples of instruments of credit include checks, promissory notes, bills of exchange, bank drafts, bank overdraft, travelers' checks, and credit cards. Advantages of credit. It helps to develop trade and industry by providing working capital. Facilitates the process of credit creation, leading to increased investment. It reduces the use of cash, which helps to reduce inflation. It encourages the development of entrepreneurship in the economy. 3. Liquidity. Liquidity refers to the extent to which an asset can quickly be converted into currency, notes and coins to be used as a medium of exchange. The level of liquidity can be influenced by the following factors: level of income, level of transaction, economics, money and banking. 45. Monetary policy of the country. 4. Credit crunch, squeeze or crisis. A credit crunch is a reduction in the general availability of loans credit. A credit crunch is usually an extension of an economic recession. It makes it nearly impossible for companies to borrow money because lenders are scared of bankruptcies, defaults, which results into very high interest rates. Causes of the credit crunch in an economy. Anticipated decline in the value of collateral used by banks to secure loans. The central government imposing direct credit controls on the banking system. Sudden and unexpected increase in the legal reserve requirements by the central bank. Sustained period of careless and inappropriate lending which results into losses for lending institutions. Reduction in market prices of previously overinflated assets / securities. 2. The central bank. A central bank refers to a central monetary institution which is responsible for financial management and controlling other financial institutions in a country operating on non-profit motive. Examples include Bank of Uganda, Central Bank of Kenya, Bank of England, etc. Functions of the central bank. Printing and issuance of currency. It has the sole authority of issuing national currency, i.e. notes and coins which are sufficient to enable the public carry out transactions. It is a banker to the government and various government institutions by keeping economics, money and banking. 46. It acts as banker to commercial banks and other financial institutions. The central bank accepts deposits from commercial banks, and commercial banks are required by law to have an account in the central bank. It acts as a banker to international financial institutions such as International Monetary Fund, World Bank. Each of these financial institutions operate an account in the central bank for their operations in the country. It is a lender of last resort to the commercial banks, i.e. if commercial banks fail to raise money to settle their customers' demands from other sources, they borrow from the central bank. It is the supervisor of the financial institutions, especially the commercial banks, to ensure that they operate within the laws established. To ensure financial soundness, it is responsible for management of foreign exchange reserves through enforcing foreign exchange regulations, and it acts as the chief custodian of all the currencies in the country, both local and foreign. It is the advisor to the government on good and sound monetary and economic issues depending on the level of economic activities, e.g. formulating the national budget, taxation. The central bank manages the country's public debt. It is involved in the acquisition, utilization, servicing and repayment of the public debt. It is a clearinghouse for all commercial banks, i.e., they settle their indebtedness through it. The central bank is the controller of credit in the economy, i.e., it uses the monetary policy tools to regulate the amount of money in circulation. Monetary policy. This refers to the deliberate attempt by the government through the central bank to regulate the amount of money in circulation so as to attain the desired development objectives, such as price stability, stable economic growth rates, full employment, etc. Categories of monetary policy. Economics, money and banking. Economics, money and banking. 48. Expansionary monetary policy. This is a deliberate government effort through the central bank to increase the amount of money in circulation in order to achieve the desired objectives of development in an economy. Objectives of monetary policy. To ensure price stability in the economy. During inflation, a tight monetary policy is used to reduce money supply to bring down prices. And during the deflation, an expansionary money policy is adopted to increase the amount of money in circulation so as to raise prices. To influence the level of employment/ensure full employment. Use of an expansionary monetary policy increases money supply, aggregate demand and investment, and thus increase employment. To influence balance of payments position. This can be achieved through an expansionary monetary policy which promotes domestic production, increases output for export, which increases the country's foreign exchange earnings from abroad and thus improves the balance of payment position. To ensure stability of exchange rates in a foreign exchange market. This is through regulation of the supply of both local and foreign currencies to avoid fluctuations in exchange rates. To influence the level of economic growth. Adoption of an expansionary monetary policy increases money supply, aggregate demand, investment, which increases the output of goods and services in the economy. To encourage growth of financial sector. This is achieved through expanding credit to enable investors expand production for the market. To influence the level and nature of investment. This is achieved by encouraging the commercial banks to offer credit facilities to the priority sectors and limiting accessibility to credit by investors in non-priority sector by use selective credit control. To help create a broad and continuous market for government securities. Economics, money and banking. 49. Treasury bills and bonds. Use of the tool of open market operations can increase the sale of government securities to the public. To influence the interest rates. Interest rates charged by commercial banks tend to vary directly with the bank rate of the central bank. An increase in the bank rate forces commercial banks to increase interest rates and vice versa. To manage the public debt. Buying and selling of government securities. Through the tool of open market operations influences the country's outstanding internal debt. Tool/instruments of monetary policy. These are guidelines employed by the government through the central bank to regulate the amount of money in circulation so as to achieve development objectives. The tools of monetary policy include 1. Open market operation. This refers to the central bank action of selling and buying back of government securities such as treasury bills and bonds from the public with an aim of reducing or increasing the amount of money in circulation. To increase the amount of money in circulation, the central bank buys back securities from the general public, and to reduce the amount of money in circulation, the central bank sells securities to the general public with an intention of withdrawing money from people. 2. Bank rate/discount rate. This is the rate at which commercial banks are charged when they borrow money from the central bank. An increase in bank rate by the central bank forces commercial banks to increase interest rate on loans given to customers, thereby discouraging the public from borrowing money from commercial bank, which reduces economics, money and banking. 50. 3. Legal reserve requirement. This is the minimum amount of money that commercial banks are legally required to deposit/keep with the central bank. To increase the amount of money in circulation, the central bank lowers the legal reserve requirement so that commercial banks are left with enough money for lending. However, to reduce the amount of money in circulation, the central bank increases the legal reserve requirement so that commercial banks have limited amount of money to lend to the general public. 4. Variable reserve requirement/cash ratio. This is a proportion of commercial banks' total deposits/assets which it keeps in cash form to meet day-to-day requirements of customers. To increase the amount of money in circulation, the central bank instructs commercial banks to lower the cash ratio so as to increase the loanable funds, and to reduce the amount of money in circulation, the central bank instructs commercial banks to increase cash ratio so as to reduce the amount of money for lending. 5. Margin requirement. This is the difference between the value of collateral security and the value of a loan to be advanced. The value of collateral security must exceed the value of a loan to be advanced with the interest to be paid. Margin requirement is increased to discourage people from borrowing money from commercial banks, thereby reducing the amount of money in circulation. On the other hand, margin requirement is reduced to encourage people to borrow money, hence increasing the amount of money in circulation. Example, if a building worth 200 0/equals is presented as collateral security against a loan of 150 million/equals. Margin requirement will be 50 million/equals. 6. Economics, money and banking. Economics, money and banking. 52 sectors so as to reduce the amount of money in circulation. On the other hand, in case the central bank wants to increase lending and money supply, it suspends the policy of selective credit control, hence encouraging borrowing by all sectors of the economy. 8. Special deposit supplementary reserve requirement. Special deposits are those deposits that the central bank demands from commercial banks on top of legal reserve requirement. In order to reduce money supply, the central bank calls for special deposits, which reduces the loanable funds, thus reducing the commercial bank's capacity to lend. On the other hand, special deposits are given back to the commercial banks so as to encourage more lending and increase money supply. 9. Moral suasion. This is a way of persuading or advising commercial banks to reduce lending in order to reduce money supply or increase lending in order to increase money supply. During inflation, the central bank appeals to the commercial banks to reduce lending in order to reduce money supply in the economy. On the other hand, during low price levels, the central banks appeals to the commercial to lend as much as they can and increase money supply. Factors that limit effective operation of monetary policy. 1. Underdeveloped money and capital markets. This limits the sale of government securities to the public as a way of reducing money supply, which makes the tool of open market operations ineffective. 2. Ignorance of the public about open market operations. This hinders effective sale of government securities and thus failure to reduce money supply in periods of inflation. This makes the open market operations as a tool ineffective. 3. Corruption in the banking sector. This makes the tool of selective credit control ineffective as investors in non-priority sectors bribe bank officials to access loans and thus failure to reduce money supply. Economics, money and banking. 53. 5. Excess liquidity in the commercial banks. This limits borrowing of money from the central bank by the commercial banks, which the bank rates as a tool ineffective. 6. High liquidity preference of the population. This results into excess amount of money out of the banking system, which reduces borrowing from the commercial banks and thus limits commercial banks borrowing from the central bank, which limits effectiveness of the bank rate as a tool. 7. Dominance of foreign-owned commercial banks. These borrow and obtain funds from sources in their mother countries instead of borrowing from the central bank, which makes the bank rate as a tool ineffective. 8. Uneven distribution of the commercial banks. Most of the commercial banks are concentrated in urban areas, making it difficult for people in rural areas to access them for depositing money and borrowing. This makes the bank rate ineffective in influencing investment, employment in such areas. 9. Conflicting government objectives. Sometimes government implements policies that increase money supply, e.g. increase in government spending, providing affordable loans, etc., which increases money supply as the central is trying to reduce money supply by use of the different tools such as increasing the bank rate, thus making such tools ineffective. 10. Limited use of commercial banks, for example due to ignorance of the services provided by commercial banks. This limits deposits and borrowing of money from the commercial banks, which makes the bank rate and interest rates ineffective in influencing money supply in the economy. 11. Large subsistence sector. This results into a low level of investment, low output, low incomes, and thus limits deposits and thus a low level of borrowing from the commercial banks, which makes the bank rate ineffective in regulating amount of money in circulation in the economy. Factors influencing operation of monetary policy. Economics, money and banking. 54. Monetary policy. On the other hand, low level of liquidity preference means that a lot of money is deposited with commercial banks and other financial institutions, thereby making the monetary policy effective. 2. Level of development of the money markets and capital markets, i.e. stock exchange markets to do with securities through which the central bank can operate. High level of development of money and capital markets leads to effective operation of monetary policy because of the many people who trade in securities. On the other hand, underdeveloped money and capital markets limit effective operation of monetary policy as there are a few people who are aware and trade in securities such as treasury bills and bonds. 3. Level of liquidity in commercial banks, which influences their frequency of going to the central bank. Excessive liquidity in commercial banks reduces the rate at which they go to central bank to borrow. This makes them remain with a lot of money for lending, thereby limiting effective operation of monetary policy, in particular the bank rate tool. On the other hand, low level of liquidity in commercial banks increases the rate at which they go to the central bank to borrow, thereby making the monetary policy effective through implementation of the bank rate policy. 4. The size of monetary sector / subsistence sector. Large commercial sector makes it effective to implement the monetary policy. This is because when a central bank wants to increase money supply, many people to borrow to expand production. On the other, large subsistence sector limits the operation of the monetary policy because very few people to borrow, even if the central bank wants to increase money supply through lowering the bank rate. Economics, money and banking. 55. Operation of the monetary policy, since few people deposit their money in commercial banks, thereby making it hard for the central bank to control such money. 6. Degree of political interference in central bank activities. High level of political interference in central bank activities in terms of influencing lending policies leads to excessive amount of money in circulation, thereby failing the monetary policy. On the other hand, low level of political interference in central bank activities allows the central bank to implement its policies according to its plans. 7. Level of accountability by the central bank officials, especially in the implementation of some tools like selective credit control. High level of accountability by central bank officials ensures that central bank officials are not bribed by commercial banks to issue loans to non-priority sectors. On the other hand, low level of accountability by central bank officials means that central bank official is bribed by commercial banks and extends loans to non-priority sectors, thereby rendering implementation of monetary policy tools ineffective. 8. Level of coordination of government objectives. In a situation where government has clearly stated objectives such as reducing the amount of money in circulation without favoring certain sectors, the monetary policy becomes effective. On the other hand, conflicting government objective limits the operation of the monetary policy, because at the time when central bank wants to reduce money, the government comes up with other projects which increase money supply. 9. Level/degree of effective in the use of commercial banks. High use of commercial. Economics, money and banking. 56. 10. Level of awareness about the services provided by commercial banks / extent of use to commercial banks. 11. Level of development of the money and capital markets. 12. Proportion of foreign-owned commercial banks in the economy. Questions. 1. Explain the functions of the Bank of Uganda. B. How can the central bank influence the rate of credit creation in an economy? 2. Distinguish between a central bank and a commercial bank. B. Examine the measures that can be used by the central bank to reduce money supply in an economy. 3. What are objectives of monetary policy in Uganda? B. Account for the low effectiveness of monetary policy in controlling inflation in Uganda. 4. Explain the tools of monetary policy used in Uganda. B. Suggest measures that can be adopted to increase effectiveness of monetary policy in Uganda.